Sir, when two customers apply for the same loan amount, but are offered different interest rates, what hidden factor influences the bank's decision, and how does this connect to the concept of risk and return in lending?
The main factor is risk. Banks assess the likelihood that a borrower may fail to repay the loan. If the risk is higher, the bank charges a higher interest rate to compensate for the possibility of loss. This additional interest becomes the expected return for taking extra risk. Therefore, risk and return are directly linked in lending decisions.
If risk plays such a critical role in determining loan pricing, what methods and tools do banks use to evaluate whether a borrower is risky or financially reliable before approving a loan?
Banks use several evaluation techniques. They review the borrower's credit history, income level, employment stability, debt obligations, and repayment behavior. Credit scoring models help quantify risk. Financial statements may also be analyzed for business loans. These assessments allow banks to estimate the probability of default.
Since borrower evaluation is so important, why is credit history often considered one of the strongest indicators of future loan repayment behavior and overall lending risk?
Credit history reflects a person's past financial behavior. If someone has consistently paid debts on time, it suggests financial discipline and responsibility. A poor credit record indicates a greater chance of future repayment problems. Banks rely on this information because past behavior often predicts future actions. Therefore, credit history significantly affects risk assessment.
If past financial behavior helps predict future repayment patterns, how does a borrower's income level further influence the bank's perception of risk and expected return?
Income determines repayment capacity. A borrower with stable and sufficient income is generally more capable of meeting loan obligations. Higher income reduces the likelihood of missed payments. Lower or unstable income increases uncertainty and risk. Consequently, banks may charge higher interest rates when income reliability is questionable.
If repayment capacity is important, why do banks still require collateral from certain borrowers? And how does collateral contribute to reducing lending risk?
Collateral acts as security for the loan. If the borrower fails to repay, the bank can recover part or all of its money by selling the pledged asset. This reduces the potential financial loss. Because the risk decreases, banks may offer more favorable loan terms. Collateral therefore strengthens the bank's position.
If collateral provides security and reduces potential losses, does that mean every collateral-backed loan becomes completely safe from risk and uncertainty?
No loan is completely risk-free. The value of collateral can decline due to market changes. Legal issues may delay recovery processes. Economic downturns can affect both borrowers and asset values. While collateral reduces risk significantly, it cannot eliminate risk entirely.
If risk can never be completely eliminated, how do banks continue operating profitably while dealing with uncertainty in their lending activities every day?
Banks manage risk through careful planning and diversification. They lend to different industries, individuals, and businesses instead of concentrating all loans in one area. They also maintain reserves for potential losses. Effective risk management allows them to earn profits while controlling exposure. Profitability depends on balancing risk and return.
Since balancing risk and return appears to be the foundation of successful banking, what exactly is meant by the term risk-return trade-off in financial decision-making?
Risk-return trade-off means that higher potential returns usually come with higher levels of risk. Investors and banks expect greater rewards when taking greater uncertainty. Conversely, safer investments generally offer lower returns. This principle guides most financial decisions. Understanding it helps institutions make informed choices.
If higher returns generally require taking higher risks, why don't banks focus entirely on high-risk loans to maximize their earnings and profitability?
High-risk loans may generate more interest income, but they also have a greater chance of default. Too many defaults can erase profits and create losses. Banks must protect depositors' money and maintain financial stability. Therefore, excessive risk-taking is dangerous. Sustainable profitability requires moderation.
If excessive risk-taking can threaten a bank's stability, what strategies do banks use to maintain a healthy balance between safety and profitability?
Banks establish lending policies and risk limits. They conduct thorough credit analysis before approval. Different categories of loans are included in the portfolio to spread risk. Ongoing monitoring helps detect problems early. These practices help maintain financial strength and profitability.
Sir, since banks monitor risk carefully, how does the economic environment influence the level of risk associated with loans and the returns banks expect to earn?
Economic conditions have a major impact on lending. During strong economic periods, borrowers generally have better repayment capacity. During recessions, unemployment and business failures increase. This raises default risk. Banks adjust lending terms and interest rates accordingly.
If economic downturns increase the likelihood of defaults, how do interest rates help banks compensate for the additional risk they face during uncertain periods?
Interest rates are a key tool for managing risk. When risk rises, banks may increase rates to compensate for potential losses. Higher interest generates greater revenue from successful loans. This additional return helps offset defaults. Interest rates therefore reflect the level of perceived risk.
If interest rates reflect risk levels, why do customers with excellent credit profiles often receive lower rates than those with weaker financial backgrounds?
Customers with strong credit profiles are less likely to default. Their repayment history demonstrates reliability. Because the bank expects fewer losses, it does not need to charge a large risk premium. Lower risk leads to lower interest costs. This rewards responsible financial behavior.
If lower risk borrowers receive lower rates, how do banks still generate sufficient profits from these safer lending opportunities?
Although the interest rate is lower, the probability of repayment is much higher. The bank expects consistent cash flows and fewer losses. Large volumes of low-risk loans can generate substantial profits over time. Stability also reduces operational costs. Reliability contributes significantly to profitability.
If reliable repayment contributes to profitability, what role does loan diversification play in protecting banks from unexpected financial losses?
Diversification spreads risk across multiple borrowers and sectors. If one borrower or industry experiences difficulties, losses can be offset by stronger performing loans elsewhere. This reduces dependence on a single source of income. Diversification improves portfolio stability. It is a fundamental risk management technique.
If diversification is so effective in reducing exposure, why can't banks simply eliminate all risk through extensive diversification alone?
Diversification reduces specific risks, but cannot eliminate systemic risks. Economic crises, inflation, or major financial shocks can affect many borrowers simultaneously. Such events impact entire markets. Therefore, some level of risk always remains. Complete risk elimination is impossible.
If complete risk elimination is impossible, how do banks decide whether a particular loan's expected return is worth the level of risk involved?
Banks compare expected profits with potential losses. They use financial models, historical data, and risk assessments. If the expected return adequately compensates for the risk, the loan may be approved. Otherwise, it may be rejected. Decision-making is based on risk-adjusted returns.
If risk-adjusted returns guide lending decisions, how do banks measure and predict the probability that a borrower may default on a loan?
Banks use statistical models and credit scoring systems. These tools analyze borrower characteristics and historical repayment patterns. Financial ratios and industry trends may also be considered. The goal is to estimate the likelihood of non-payment. This probability influences lending decisions.
Sir, if default probability is such a critical factor, what happens to a bank's profitability when a large number of borrowers fail to repay their loans?
High default rates reduce interest income and increase losses. Banks may need to write off unpaid loans. Additional reserves may be required to cover future defaults. This affects profitability and capital strength. Therefore, controlling default risk is essential.
If controlling default risk is essential for financial stability, how do banks continuously monitor borrowers after a loan has already been approved?
Monitoring does not stop after approval. Banks track repayment performance, financial statements, and account activity. Warning signs such as missed payments are closely observed. Early intervention can reduce losses. Continuous monitoring supports effective risk management.
If ongoing monitoring helps identify problems early, how does technology improve the bank's ability to manage risk and maximize returns?
Technology allows faster data analysis and more accurate risk assessment. Artificial intelligence and predictive models identify patterns that humans may overlook. Automated systems improve efficiency in monitoring. Better information leads to better decisions. This enhances both risk control and profitability.
If technology strengthens risk management, what challenges do banks still face when trying to balance risk and return in a rapidly changing financial world?
Economic uncertainty, regulatory changes, cyber threats, and market volatility create challenges. Customer behavior can also change unexpectedly. These factors make risk assessment more complex. Banks must constantly adapt their strategies. Flexibility is crucial for long-term success.
If adaptation is necessary for survival, how do regulations influence the amount of risk banks are allowed to take when issuing loans?
Regulations protect the financial system and depositors. They require banks to maintain adequate capital and follow responsible lending standards. These rules limit excessive risk-taking. Compliance promotes stability and trust. Regulations therefore shape lending behavior.
If regulations promote stability and responsible lending, what qualities should future banking professionals develop to effectively manage risk and generate sustainable returns?
Banking professionals should develop analytical thinking, financial knowledge, ethical judgment, and decision-making skills. Understanding data and market trends is essential. Strong communication also helps evaluate clients effectively. Continuous learning is important. These qualities support sound risk management.
Sir, after discussing risk assessment, collateral, interest rates, diversification, regulation, and profitability, what is the single most important lesson every finance student should remember about risk and return in bank lending?
The most important lesson is that risk and return are inseparable. Higher returns are only valuable when the associated risks are understood and managed properly. Successful banking is not about avoiding risk completely. It is about taking calculated risks that produce sustainable profits. Long-term success comes from balancing opportunity with responsibility.